today I am super delighted for our next guest, who is Jason Barsema, who's the co-founder and president of Halo Investing, a fintech unicorn company here in Chicago.
I respectfully believe, regardless of what religion you believe in, if any at all, is no matter who he, she, it is, when we are called and we are judged, assuming we're judged by someone, we're not measured by the size of our wallet, we're measured by the size of our impact.
How's it going, everybody? Welcome back to the More We Know podcast. My name is Mir, your host. The More We Know podcast is the world's mentorship platform where we bring you on mentors every single month to provide you real-life mentorship in your pocket from wherever you're at, whether you're on the way to work, whether you're at the gym, whether you're at school, whether you're at home, whether you're with your spouse. We want to provide you mentorship from around the world from the best experts, where we bring on people like the former CEO of Chipotle, the founder of Reebok, the founder of Anytime Fitness. And today I am super delighted for our next guest, who is Jason Barsema, who's the co-founder and president of Halo Investing, a fintech unicorn company here in Chicago. Jason has a wealth of experience, not just being a co-founder, not just being a CEO of a fintech company, but growing up in this industry, working for one of the largest banks like Credit Suisse. Halo, if you haven't heard of them yet, you're going to want to look them up after this interview, because we are in for a treat with your mentor today, who is Jason. I'll have him dive more into his background. Jason, thanks for coming on today.
Thank you so much for having me.
Jason, let's dive into it. As you know, this is a mentorship podcast, so it's almost like the guests are here with you, learning from you. It's not every day we get to learn from someone who built a $1 billion fintech company and raised over $100 million and has a 175 employee company now. But before any of that, let's break it down. Who was Jason as a child? What did your parents do? Walk me through the childhood, Jason.
Yeah, well, I don't want to scare everybody. No, I was very blessed to be able to grow up in an entrepreneurial household, and so, I was born in Indiana, which a lot of people don't know, but my family moved around a lot. So we were in Indiana, St. Louis, Chicago, Tampa, and then Silicon Valley ultimately by the early 90s. And I was really raised, by my father and of course my mother, but, my father on the entrepreneurship side, he and his partners created a company called Redback Networks in the early 90s that pioneered the first router for broadband internet, which that internet thing turned out to be pretty good. Yeah. And ultimately, he saw a really big problem that needed to be solved, which is just the way that the internet was coming about and the computing power that was going to be required to process all the data that was required through the internet. You needed to have better routers, or else you'd have a big choke point. And so, they created really the next gen router, which then they took public in 1999. Turned out to be the fifth most successful IPO in Wall Street history, which was pretty neat. Wow. And it was a great ride for me to learn, about the blessings of building a company and taking it all the way, but also the pains. And so that's what I always talk to a lot of entrepreneurs who are listening here. Yes, you can hear Halo's story. Yes, you can hear my father's story, and it sounds good, and it is good. But what a lot of entrepreneurs don't talk enough about is, what are the pains that got you to where you are today? Because there's no straight line up, and there's always ups and downs, and you just want more ups than downs when building a company. But he was really my lifeline. He was really my guide. My father's my mentor and my best friend. He's also my toughest critic. But to that point, after Redback, he joined a venture capital firm called Benchmark Capital, where he was one of the early venture partners there. And Benchmark is one of the most prolific VCs in the Valley. And so it was really nice to grow up in a household where I learned how to build a company, which my father did, but also how to invest in companies, which taught me the VC approach and angle. Very, very beneficial in regards to building Halo.
When you think of some of our listeners, Gen Zs that have parents that, really push them to go to school and get a good job. And, it's not every day you have someone as exceptional as your father that was able to build one of the most legendary IPOs in Wall Street history. Did that ever weigh on you growing up? Like, there's a standard I have to meet, or was it more just inspirational?
Well, it's a joke within my family. My dad always used to say, "You've got big shoes to fill." And I always used to joke, "Well, I got big feet." And so, we come from a very competitive family with the Barsemas. But, at the end of the day, it's, this is a lot of the advice that I give entrepreneurs too. It's the same advice my father gave me, is there's two types of entrepreneurs out there. There's some who identify a really big problem that needs to be solved, and they feel like they are the only ones who can solve that. And then there's others who come up with a good idea, and then they're trying to search for market fit. The latter usually don't make it. And if they do, it's usually not the big, exits or the IPOs. And I always encourage entrepreneurs, and it's the same thing that my father encouraged me growing up, is find your passion. Whether you want to be an entrepreneur, whether you want to be a school teacher, whether you want to be a civil servant, within your community, find your passion. If you have a mission-driven approach and you have a passion for what you do, you'll be successful. And you'll be able to monetize it. And that is where my dad and I disagree. So if you're listening, Dad, I know what you're thinking. But in my opinion is you want to find your passion, because doing anything in this generation, right, is hard, right? It's very competitive out there. It's truly a global landscape, even more global than when I was growing up. And so with that, if you want to be successful in life, really take the time to think about what matters to you, why you do it, and how you're going to solve that problem. And that was the genesis of Halo. As you alluded to in my bio, I spent my career at Credit Suisse. I was a partner on one of the largest private banking teams there. And I managed one of their largest private banking practices for ultra high net worth individuals, institutions, and family offices. And I got into that because, my dad put a journal in my hand when I was 5 years old. And I just fell in love with economics and finance. I don't understand a lot, but I get the markets and I get economics. And so I wanted to go into private banking because I wanted to serve. I love to serve. And as I said, I'm not a pleaser, but I love to serve. And for me, if I wanted to give back to society and give back to the community, who are the people who are donating the majority of the money to, these non-for-profits? It's family offices and ultra high net worth individuals. And so my thesis was, hey, I love to teach. I love to help, I love to serve, and I love the markets. In private banking, if I make these wealthy people wealthier, then there'll be more money to give. And ultimately, I kind of had an epiphany of saying, well, what about the rest of us, right? What about the 99% out there, the firefighters, the teachers, the police officers, the veterans who don't have sufficient savings, who instead of having their portfolios outlive them, it's the other way around, which is all too often in this country. And the savings crisis is the largest epidemic we face as a nation. And that was ultimately the genesis of Halo. And that's, I think, why we've had the success that we've had, is because we found a really big problem that needed to be solved, that we felt we were the only ones who could solve it.
I'm super fascinated by the inception of Halo, and I can't wait to get into it, because that's a whole nother animal. You can be able to find and identify a big problem you need to solve, but the other part is execution, which is a huge, it's its own different thing. Yeah, 90% of it's execution. But before that, so you graduate college. Was your first job at Credit Suisse?
It was. And so I have a boring life. And so I grew up a golfer. I'm short and bald, so there's only only one sport or a couple of sports I'm going to be good at. Golf was one of those. So I grew up playing competitive golf. I studied economics and business in college, and I graduated from Northern Illinois University. Go Huskies! And ultimately, I took my first job at Credit Suisse as another thing that, not to dissect or divert from the conversation at hand, but something that my father encouraged me to do, at a very young age, is really build out your life plan. And I started to do that when I was in middle school and in high school, which is ultimately start with the end. Who do you want to be when you grow up? What do you want to do? And for me, I ultimately wanted to serve my country. I wanted to be a U.S. senator. To be able to be a senator and serve my country in Washington, I knew I had to have a more or less a grandiose career. I got finance, so I wanted to be CEO of a major financial institution, and I worked myself back to where I needed to start, if that makes sense. And so, with that, I knew that I needed to join a big Wall Street firm, which is why I joined Credit Suisse in
New York.
So I joined actually in Chicago. So I had opportunities in New York with a variety of different institutions, but at the time it just made sense for my family to be here in Chicago. And so I joined Credit Suisse Private Banking as the lowest rung analyst you can possibly be. I made $30,000 out of college, which was not that long ago. I graduated in December of 2007. Wow. And I built my career just like we built Halo the hard way. And that's also a tagline of NIU, which I love. I love that as an entrepreneur, of the hard way. And so nothing in life comes easy despite what you read. in the news or what you follow on social media, it always looks so easy. It ain't. And so, I think that honestly, if you haven't, and that's what a lot of the advice that I give entrepreneurs too, and just people that are about to begin their professional careers, if you haven't failed, then you haven't tried hard enough. Mm-hmm. And so, that's really what I just jumped neck deep into, is being an analyst. I did everything I possibly could do to be able to work myself up into making partner when I was 27 and a half. Wow. I built one of Credit Suisse's best businesses on the private banking side, alongside with my team and my partners there. And ultimately, it was a blessing. And, from the side of entrepreneurship, I just had a bell ringing in my head, and not talking about religion on a podcast, but it's the closest thing I can relate to of getting a calling from God of, this is what you need to do. And so I gave it all up. I transitioned my entire book back to Credit Suisse without a nickel, in return. And I bootstrapped my company, and here we are today.
Talk about going from, when you're at partner status, it's an incredible feat in itself, you have ultimate sort of comfort, right? You make $500,000 plus a year, you have benefits, everything, you have assistance, more, $1 million plus. And it's just, the benefits are there. The paycheck is every 2 weeks. It's guaranteed. The bonuses, you leave that at 27?
Yeah. I became a partner at 27. I left to start Halo when I was 30.
Okay. Now, interestingly enough, Jeff Bezos has a similar story where he was walking, he told his boss about starting the bookstore. And then he was walking down, his boss gave him a talk. Said, that sounds like a good idea for someone who doesn't have a great job like you.
Yeah.
And eventually he left the same way. He was a partner in Wall Street and left to start Amazon. What is it, for people listening, what does it take? Like, what was that shock factor to leave such a high paying, comfortable job and go be crazy? Because you have to be directionally crazy to launch, right?
You said it perfectly. I always say, if you want to be an entrepreneur, you're absolutely insane. And I embrace insanity, by the way. And to that point, again, I think it's about doing something that's bigger than yourself. And again, not to keep on going back to, my parents, but that's something that I always learned when I was young. My family is very philanthropic. And so, I respectfully believe, regardless of what religion you believe in, if any at all, is no matter who he, she, it is, when we are called and we are judged, assuming we're judged by someone, we're not measured by the size of our wallet, we're measured by the size of our impact. And I fundamentally believe that. And so, going back to that quote unquote calling was like, how are people going to remember Jason? Are they going to remember Jason for being a really good private banker who made a lot of money? Or are they going to remember Jason of trying to make the world a better place and create a positive impact in the world and help solve this savings crisis, which, oh, by the way, the leading cause of stress, death, divorce, and suicide in the United States is financial related. And so, do we want to create a positive impact in the world? And for me, that was really, really important. And I think for anyone who is an entrepreneur, you can relate to what I'm saying, because it doesn't matter if you take a company public. It doesn't matter if you're bought for billions of dollars or $25 million, or you go up in flames. Failure is a badge of honor in Silicon Valley. And it's a badge of honor as long as you failed in the right way. It's a badge of honor because at least you tried. And you tried, and that's more than 99.9% of people can say. And we need a lot more people who try. And if we get a lot more people who try, this world will be a better place. And I'm not trying to stand on my social soapbox, but just for me, that was what was important to me. And that's the importance and woven into the fabric of our company. We wrote our value statement. Me and my co-founder wrote our value statement before we wrote our business plan. And that value statement was impact before profit. And it's not impact over profit. It's impact before profit. We are for profit. But my respectful opinion is that if you create a positive impact in the world and you're changing the world, then obviously people value what you do. And if they value what you do, as I said earlier, they'll pay for it. And it's cyclical, right? So if you create impact, you're going to create profit. And that profit goes back into creating more impact in the world. And that's really the foundation of what we believe in. Today, Halo's in capital markets. In the next 5 years, mark my words, we will not just be in capital markets. There's other big world problems that we need to solve.
Yeah, and I can hear it in your voice and the energy. And from when you and I first met at Soho House, just how passionate you were talking to all these advisors about what Halo does.
I've only had one cup of coffee. Wait till you see me caffeinated.
We got to run it back when you're more caffeine. Okay, so you leave the job, you go and launch Halo. And obviously, I love the mission statement you guys had, you and Beju. But What does that like? What does that actually look like? Like people talk about launching a business. What actually does that mean? Like from like getting your capital together, building an LLC. Like what did launching Halo actually mean?
It's a lot. I am a first-time entrepreneur. The other blessing that I've had in my life is meeting my co-founder, which was very serendipitous. If you are an entrepreneur, you know what I'm talking about. If you're thinking about becoming an entrepreneur, I highly recommend finding a good co-founder. And we can talk about that in a little bit of, what you want to look for, in a co-founder. But, I found my co-founder who's a serial entrepreneur. This is his fourth startup, but Bijou was an options quant by trade, created an options trading consulting company. He then created Redbox. He was the co-founder of Redbox, the movie rental kiosk, which had a very successful exit to Coinstar in 2009. And then he did a retail online options brokerage called Trading Block, which was also successful. And he was just exiting Trading Block, and I came together with this crazy idea about structured notes, and he didn't really know about structured notes, a little bit from a high level, but he understood the derivatives and what went into a structured note.
You'll have to explain to us what structured notes mean.
Absolutely. Yeah. Absolutely. And, but to that point, I was very blessed to have Bijou, who's created companies before, my father, who's created companies before, serving my clients at Credit Suisse, who've created many companies before. But it's a lot. And it's always hard because people are like, well, what do you do first? And honestly, like, I don't know. What we did first, so I'll just tell you what I did, is that, over the course of 4 to 5 months before I flipped the keys to my partnership back to CS and I left the firm, is that, we didn't really build out a business plan. It was more just about the conceptual idea, right? And then we just got a lot of feedback. And what I find about a lot of entrepreneurs is they work really hard on this really beautiful, elegant, and sexy business plan, but they don't get enough feedback from the streets, and everything changes once you're on the battlefield. And so we spent more time getting feedback of what our clients want, how they relate to the product and the technology that we were building, what we could be doing better. And then that was really that. We bootstrapped the company ourselves. We hired a consultant as our first developer because we were bootstrapping the company ourselves. And we really built a true MVP. And that's what I encourage a lot of other entrepreneurs. And that's just what's done every day in Silicon Valley is, there's a line, again, that my father uses called get mo. And get mo is not about get more. It's about good enough to move on. Mm-hmm. It needs to be 70% of the way there. You'll figure the rest out on the battlefield. And that's kind of what we did. We built a very basic prototype. We got really good feedback on it. We went out and got a couple customers. It was nothing sexy, but it did the job. And I always relate that back to the first PayPal. If you ever looked at the first PayPal, and Jack Selby is one of the co-founders of PayPal. PayPal Mafia is one of our senior advisors at Halo. Wow. And so if you look at PayPal, and pardon my language, but it was a piece of crap. Yeah. The very first one. But you know what? It did its job and it added value and people liked it. And so that's what I always tell entrepreneurs. You don't have to have the beautiful UI and the beautiful, interface and all the great marketing to be able to be successful, launch a company. If you add value, then people will buy your product, period, no matter what it looks like. And that's what happened for us. And so we went out and we raised a seed round of capital on a convertible note. And
what does that mean?
And so I'm glad you asked, because that was something I wanted to get into for a lot of entrepreneurs, especially in the Midwest, they're not as familiar with convertible notes. And so a convertible note is technically debt financing, but instead of paying an interest rate in cash, the interest rate is paid in shares. And so when you issue a convertible note, you issue it off of a cap, right? So this is a cap is basically your effective valuation you're going to give the investors when you actually go and raise a Series A round. So whoever buys a convertible note is basically locking into an effective valuation that will be lower, obviously, than what you raise your Series A at. And so you either get the cap as an investor or you get a discount to your Series A, whichever is more beneficial to the investor, right? Obviously, if you're doing your job right, you want to be able, investors aim to get the cap because hopefully your Series A is above the cap and that would be more beneficial to the investors. And so when you go out with a convertible note, you basically dictate what that cap is going to be, what's the discount to the Series A going to be, and you negotiate that both of those. And then what's the interest rate you're going to pay on that convertible note, which again is paid in shares. So accumulate shares. And so everyone invests in this note. You hold the note like any other bondholder. Again, it's technically debt, but the nice thing is you're not paying cash money, which you don't have when you're raising your seed round. And that convertible note converts into preferred Series A equity when you go and raise an official Series A. Why do you do that? And this is the problem and challenge with a lot of Midwest entrepreneurs is you have no clue what your valuation is. And so when you don't even have a product, certainly don't have revenue.
This was before a customer or anything?
Yeah. I mean, for us, we had a few customers, but we didn't have revenue.
Yeah.
And our customers were more like pilot customers. It wasn't like we were working with a JP Morgan. We were working with local RIAs, your Chicago Wealth Management partners. I'm just making up a name.
Yeah.
And so just a local RIA to get the proof of concept. And we strategically started with those types of clients because it's an easy yes. A lot of entrepreneurs go to the big whales, right? Of like, oh, I'm going to go and try to get a big contract with, if you're in capital markets, a JP Morgan, a Credit Suisse, a UBS, a Bank of America. You'll run out of cash before you close that deal. Those deals take years. And we knew that because I spent my career at one. And so we went out to the independent RIA community, which are wealth advisors at a Schwab and a Fidelity. If they like the product, they can say yes, and you can trade today. And that was really smart for us. So getting back to the convertible note, at the end of the day, what was nice about this, I had no clue what my valuation is. And so I was like, okay, we're going to set a valuation. If I'm wrong, Mrs. Investor, on what I think that valuation is, great. I'm going to give you a 20% discount to the Series A. So if you think I'm overshooting on the cap that I'm putting, I'm going to give you a 20% discount, which was our discount to the Series A. And so let's say our cap, which it was a $15 million cap on our seed round. We gave a 20% discount. So if we did our Series A, to do math, right, at $10 million valuation, well, they're not going to get the cap because the cap's at 15. They're going to get the 20% discount. So the convertible note holder's effective valuation would have been $8 million. Now, we did our Series B round or Series A round, at a $35 million valuation. And so,
and how'd you reach that valuation?
On the Series A?
Yeah.
Well, it's, but by the time you get to Series A, you have like clients, you have revenue. So it's a little combination of Series A of, do they believe in the founders? Do they believe in your vision? Do they believe in the addressable market as something that's interesting to invest in? But then it's also a blend of real numbers, right? It's like, okay, have you shipped your product? Are you creating revenue? It might not be a lot, but are you creating revenue? And so in your seed round, right, your pre-Series A, you hit the nail on the head. That's the hard part, is how do you derive a valuation? You don't even have a product. You barely have a business plan. You're trying to convince someone to believe in your dream. And so that's what's the beauty about a convertible note, is that you as the entrepreneur don't have to stress about, oh, do I have the right valuation? Am I giving up too much, too little? La, 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 la. And it worked out well for everybody because I got, the shareholders got that interest rate that accumulated in cash, for the 2 years that we had that convertible note until we raised the Series A, and they got a great valuation. And so, and the reason why this is important, not to belabor the point, but the reason why this is important, I see a lot of entrepreneurs in Chicago who, specifically, because that's where we're based, where they go out and they raise their Series A at $5 million. And they raise it at $5 million because a lot of the funds, in the Midwest, and now I'm proud to see those funds getting larger, but a lot of those funds are, $50 million funds. How many portfolio companies do you have in a fund? Well, about 30. So you can do the math, right? Is what's the capital that they're putting into any of those companies? It's about $2 million. If you look on average across all the VCs, a lot of VCs want to take a pretty big chunk in your Series A. And so they want to take 40% of your company, 30% of your company right out of the gates. Voila, they have $2 million to invest. They want 30 to 40% of your company. There's your $5 million valuation. That's how they derive the valuation.
Wow.
And so a lot of entrepreneurs don't think about that. And so when you go out and raising capital, consider convertible note, because that can take all of that stress off the table. Does that make sense?
That makes total sense. I think that was a masterclass on the convertible note, because you see that sometimes. Everyone always talks about the Series A, B, C, but when I get asked that question a lot, what does the convertible note mean? And we had finally someone come explain it, and it just
yeah, you'll see a lot of interest in safe notes too,
okay.
work a little bit more in favor of the entrepreneur, similar to a convertible note. In this type of environment, you're not raising off a safe note. I like convertible notes because the way I do business is mutually beneficial partnerships. And so it's a two-way street. Someone's giving you their capital. Someone is betting on you that you can execute, right? You know, just the idea is 10%, I promise you.
Execution.
The other 90% is execution and luck.
Yeah.
And so what the convertible note side is, it allows both people to benefit. So when you're pitching that, when you're pitching that investor, you could say, look, we can argue till we're blue in the face over the cap. And here's why I think the cap is a cap, and go out and get comps and go out and defend it to the death, right? But you don't have, that's not your only point of leverage within the negotiation. Like a Series A, that's your only point of leverage is your valuation. So now at the convertible note, you've got 3 points of leverage. You've got your cap. Okay, Mrs. Investor, you don't believe in my cap? Then I'm giving you a 20% discount to whatever that is, to the Series A. So if I raise less than the cap, you're going to get a 20% off. And oh, by the way, I'm going to pay you on average a 6 to 8% interest rate. Our convertible note was 6%. And the market's usually 6 to 8. That accumulates in shares. And so you're literally getting paid in more shares to wait for us to actually go out and raise a really good Series A round. And that's what I really encourage. You know, a lot of entrepreneurs put a lot of weight in, hey man, I raised a Series A. The only thing that matters is points on the scoreboard, brother. And so doesn't matter about how much you raise, doesn't matter of what round it is. The round is an alphabet soup these days. You know, when we were growing up in the Valley, after a Series C round, you may have a D, and then you're out, right? Like you're an IPO or an acquisition. Nowadays, they're seeing, you know, F rounds and G rounds and H rounds. And I think we're going to start to hit AA rounds because we've already gone through the letters of the alphabet.
The whole thing with this, it's going to be a tougher environment, but absolutely. And you hit on an important point there, which is, you know, go out and get the points on the scoreboard. So many entrepreneurs, what do you say to them when they start saying, well, hey, Jason, look, we have a great idea. Me and my co-founder, we don't want to give up equity. Like, we want to bootstrap this ourselves. There's this fear of giving up equity to VC because, one, less money for you, but two, not only dilution, but they're worried about VCs taking control of the company and telling, because you know how to, Jason, run Halo better than probably the investor does initially. You know, how do you balance that with that? Like, how do you pick the investor versus, if that makes sense?
Yeah, it makes perfect sense. Number one is the advice that I would give, and the rebuttal I'd give to that is 100% of zero is still zero by my math. And so I talk a lot of entrepreneurs to say, well, geez, I don't want to give up equity. Okay, well, would you rather own 20% of Amazon or 20% of Stripe? Or would you rather own 100% of a $5 million enterprise value? And so I think I would choose the former. And so, you know, for us, but at the same point in time, be mindful of your capital. It's your equity. And the most expensive equity is your first equity, which again is it's just math when it comes down to venture capital and capital raising. A lot of entrepreneurs don't appreciate that because who holds all the shares? You do as an entrepreneur. So as you're selling equity in your company, all of that equity in dilution is coming from you, right? As you get into later rounds, that dilution gets spread, across all of the investors that are in your rounds. And so it's really important to know, how to raise capital. Be frugal. Again, there is no badge of honor that's given to people who say, I raised $100 million in my Series A round and I did it at $150 million valuation. No one cares. Yeah. And so, raise as little as possible. And by raising as little as possible, it also makes you honest. I think it makes you hungry, and I think it makes you a lot more efficient. And so, a lot of money sloshing around makes people sloppy. And so we've always been very prudent with the amount of capital that we've raised. Getting back to your question about who, that's the $1 million question. And so when you think about who you want on your cap table, it's a very, very important consideration. For us in our convertible note, we went out to individuals that were in our industry that could help open up doors and help bring clients in. It wasn't the dentist, it wasn't the doctors. We were very strategic about who we wanted and from what industries, whether it's from trading, whether it's from exchanges, whether it's from banks, whether it's from RIAs. We had a mixture of all of the above because I needed all of those parts for Halo to really come together and have a viable product. Mm-hmm. And so that was our approach, number one. In our Series A round, we went out to VCs that really understood my business. Nothing against Silicon Valley VCs because they're amazing and I'm the son of one, but they don't understand capital markets in regards to what we do of structured notes as much as other VCs in a New York or a Boston do. And so, when you look at Valley VCs, they're more like direct to consumer, which were B2B. They're more payments and lending, or neobanks, which is totally cool and very important, just not my business.
Sure.
And so we had a lot of interest from these Silicon Valley VCs and the biggest names out there, but we just respectfully said, not right now, because we weren't ready for that yet. And we wanted to focus on VCs that could really help move the needle. The brand of your VC in the very early stages, in my very respectful opinion, does not move the needle as much as it does in your later rounds. In your later rounds where, Halo completed Series C, as you alluded to, and we likely have one more round left for more strategic purposes before, our exit ultimately comes in the next 3 or so years, ceteris paribus, subject to market conditions and execution, all the other disclaimers I can give. But, all jokes aside that's when the brands really do matter. In the early stages, it's the value that matters. What are they bringing to you? It's a two-way partnership. Always remember that.
Yeah. And I'm just thinking out loud because I had interviewed we were just speaking about the Gino's and Marty's restaurant. That was the same thing when they were looking for investors. It was who can connect us in the restaurant space, who can do this. So the strategic part, a lot of times people discount how important it is to be with the right network of type of investors. And again, to your point, without saying names, if you look at a lot of the VCs that funded a lot of fintech companies, a lot of them didn't understand the landscape of the RIA space. How I'm always fascinated by the RIA space moving the slowest out of like any industry. Like they're so slow to move towards the technology. That was just a great masterclass there. Now, having said that, Series A, Series B, Halo is all over the news last year. You guys raised $100 million and some from heavy hitters. One mentioned in Dubai.
Yep. Abu Dhabi.
Abu Dhabi. Yeah. Talk about raising $100 million and the process there. I mean, I'm super fascinated by that.
It was amazing. It was one of the best experiences of my life. Again, it goes back to what you read in the news of everyone. It's so easy to raise capital. And I always say, maybe it's just me, but if it's so easy to raise capital, then you ain't trying hard enough and you're not maximizing your value enough. But again, there's got to be a give and take. It's not all about maximizing your valuation. For us, it was not about maximizing our valuation. It was about maximizing our partners for the stage that we were at within our company. And so we wanted to bring in investors that have invested in Halo through all the previous rounds, which were the majority of our investors. But we wanted to introduce new investors into Halo that could help take us to the next level. And so, just highlighting some of our big investors, our C round was led by Owl Capital, which they and their partners have been involved in many of the biggest fintech companies in Silicon Valley. And that was the right time for us. Now we're at the right stage where I can use that help and that advice. And you might be saying, well, what do you need from a VC? Yeah. And Owl understands capital markets, perhaps not structured notes at the beginning, but they understood capital markets. But you know what they understand? They know how to scale a business. They know how to operate a business. They have a great access to talent as we go out and build a professional leadership and management team, which we've had. They know how to take companies all the way, and they know the trials and tribulations to get to Series C all the way to the exit. And that's really important. And we are ready for that. We were not ready for that in our Series B and our Series A. A couple of new additions to the cap table was Mubadala, which is the sovereign wealth fund of Abu Dhabi, which is the capital of the United Arab Emirates. One of the best investors I've ever had in my life. And I'm not incentivized to say it. I'm not paid to say it. A lot of people joke I'm Mr. Abu Dhabi. It is my home away from home. It is a blessing truly to have them as an investor. They've been the best partners I've ever had. And they've been the best partners I've ever had because they've got experience all over the world. They're loyal, they're faithful. They're a pleasure to work with. They're truly my partner. And they've helped open up a lot of doors for me that I wouldn't be able to open up on my own. And it's just a cool place to be. It's like, it's the closest thing, the UAE is the closest thing I'd say is like a startup that's a country. Mm-hmm. Like the world is your oyster in a good way. Like if you can dream it and if you can build it and if you can execute it, you can do it in the UAE. And that is super cool. There's not a lot of places under a credible regulatory environment. There's not a lot of places where you can do that under a credible regulatory environment. And so we're very honored to have Mubadala as our investors, as we are honored to have our other investors like Allianz. We recently got into annuities. It's important to have that annuity landscape. Allianz does not have a board seat though, so we remain independent and agnostic. It's important, whatever business that you're in, think about the optics in the landscape of who your investors are and who sits on your board and who's got access to information. We're very sensitive to that. So, Allianz has no access to information. They do not have a board seat. And I'm proud to say that, and they are too, because they really believed in our mission and our vision. But they're the world's largest insurance company. Mubadala is one of the world's largest sovereign wealth funds. And then we've got William Blair, who's a great partner with us. They don't have a board seat as well because they're a financial institution. And then Koch Industries, which is the largest private company in the United States. But at the end of the day, we've got a wide variety of partners who can help us grow, operate, scale a business, who can help us understand capital markets. And as you and I were talking offline, Halo won't be a capital markets company in the next 5 years, just a capital markets company 5 years. We got a lot more impact to create.
And talk about that impact. So what does Halo do?
And so Halo today is a two-sided marketplace that has disrupted and democratized the $3 trillion market of structured notes. If more than 1% of your audience knows what a structured note is, I think I'll put $1,000 on the table. It is the biggest market no one's ever heard of. It's a $3 trillion market globally, meaning there's $3 trillion of structured notes outstanding around the world. $1.3 trillion, not to be too specific, but we are Halo, but $1.3 trillion of structured notes get issued every single year around the world. About 100 billion of that is in America. So ironically, if you do follow capital markets, there's not a lot of asset classes that, America doesn't hold the predominant market share. And, in this particular case, America has always held around 7 to 10% market share, versus Europe that does about 400 billion and Asia that does 600 billion. So getting back to structured notes, a structured note is basically manufactured and issued by a major bank, like a Bank of America, like a Morgan Stanley, like a Citigroup. Technically, it's an investment package of a zero coupon bond and a derivative. But more simplistically than that, it's insurance around your investment, right? So I always educate people of saying, look, you might buy the stock of Apple, right? Your audience may love Apple. And when you buy the stock of Apple, we all know you get the benefit of all the upside. However, you also get the benefit or demise of all the downside. And that's been particularly challenging in this market because it's been a very volatile market. Consumer behavior, the pains of losses outweigh the joy of gains 2 to 1. And so to that point with a structured note, what a structured note does is allows you to get the majority of the upside of Apple, where you're not going to get all of it, but you may get 90% of the upside of Apple. But in return, you're going to protect against, say, the first 30% of declines. So what does that mean? Every structured note has got 4 variables. So for those listening, if you can understand these 4 variables, you can understand any structured note out there. The first variable is the maturity date. Every structured note's got a maturity date, like a bond or like a CD if you ever bought a CD before. That maturity date can be 3 months to 10 years. The financial advisor picks it. Halo is a B2B company. Most maturities are 2 to 3 years. What does that mean is that the terms of the note only matter at maturity. The second variable is called the underlying. Every structured note is linked to the performance of an asset. That asset could be Apple, like I just said. It could be an index like the S&P 500. It could be a commodity, currency, interest rate, whatever you want. We've got 3 billion combinations on Halo. So whatever you want to invest in, I can almost promise you we've got it. But traditionally, people buy structured notes linked to the performance of indices and stocks. Sure. The third variable is the payoff, is the participation rate that I was just telling you about. Hey, I'm going to give you 90% of the upside. I'm not going to give you 100. I'm going to give you 90% of the upside. Meaning, if you had a 2-year note on Apple, and Apple for round numbers was up 100%, you're going to be up 90%, right? And in return for not being up 100%, that 10% discrepancy, right, versus buying Apple stock outright, is that we're going to protect you against the first 30% of losses. So if Apple's down 0 to 30, you're down nothing. If Apple's down 31, you're down 1.
Really?
And that's the beauty of structured notes. And people say, well, geez, why do I need structured notes? And I always ask, I said, well, do you drive a car? Most people say, yeah, I do. I said, well, you definitely drive a car with insurance, don't you? Because if you don't, it'd be illegal. But why do you drive a car with insurance outside of it being illegal? Is because you don't know. You're protecting against the unforeseen, right? If you own a home or live in an apartment, you probably have insurance on your apartment or your home for the same reason, to protect against the unforeseen. God forbid, hopefully nothing happens, but in case it does, that's why you have insurance. It's the same thing with your investment portfolio. So you have insurance on your home, you have insurance on your car, you have insurance on your dog, for Pete's sake. But you don't have insurance on the most important thing in your life, which is your investment portfolio, outside of your family and children, of course. But from a financial matter, one of the most important things in your life is your nest egg. Mm-hmm. Case in point of why this is important. Last year, a blended 60-40 portfolio was down 20%. So that's a challenge, right? The diversification of stocks and bonds failed last year. Newsflash. You know what the average retail investor was down according to JP Morgan last year?
What was it?
40.
40, average retail.
Average retail according to JP Morgan Asset Management. 40%.
Oh my gosh.
And so that's double of what the market was, a fully diversified portfolio. And so what has happened? A great article in one of the major news outlets earlier this week about, unfortunately, which is this always happens, is that people get spooked. You lose 40%. We're all guilty of it. We're just saying, hey, I'm out. If you're at the blackjack table, it's like, I lost as much as I can stomach, right? So you're out, and now you're in cash. And now you just missed a really nice rally in the first quarter.
Yeah.
And all of that was sitting in cash. At least cash is yielding you 4% if you're at a higher yielding institution. But that's the problem. And that's ultimately the benefit of structured notes, to say, look, hey, if the market's down, you've got the protection. It's okay. So structured notes not only help you stay invested so you don't panic and you don't blow out, you've got the protection. You're getting the majority of the upside. But just as important, structured notes help you get invested. Because now it's like, well, geez, what do you do? The market's already rallied. Are you going to put your cash to work now? I don't know. I don't have a crystal ball, neither do you. And so that's the benefit of ultimately what these products do, because I could say, hey, now is a good time, potentially, and I don't give financial advice, but now is potentially a good time to still get into the financial markets. But if I'm early or wrong, it's okay. You've got the protection, right? Just like if you were driving a car 100 miles an hour, it's, hopefully nothing happens, but it's okay. You've got insurance. You've got the airbag. That's what a structured note does, is it protects against the unforeseen without having to give too much on the upside. And it's not rocket science. It's not some black box voodoo. It's just this bond, and it's just an option. But most of us are not professional derivative traders, nor do we want to be. And that's where a structured note is just a pre-assembled option strategy that's easy to understand. It's like buying the Mac instead of going to Fry's Electronics and buy the motherboard and the hard drive and picking your CPU.
Yeah. And it's funny that you say that, because my next question to you was going to be
how to assemble a computer.
Yeah, that was my next one.
That's talking about my co-founder.
I got to speak to Beju about that. I was going to say, like, hey, why do that when Robinhood, which, AUC, assets under custodian, majority is retail, right? It's all retail clients. They could go in and they'll tell you, hey, Jason, well, I love Tesla. Why don't I just buy puts or covered calls on Tesla?
Great question. Well, there's 7 reasons in particular. We don't have time to give all 7, but the headline is twofold. For a lot of the products that you want to create with a deeper level of protection, maybe you want to go further out maturity, like a 3-year or a 4-year note. Maybe you just don't want to buy it to Tesla. Maybe you want to buy a basket. You could create your own basket with a structure of Tesla and Apple, the 50-50 weighting, or it's a structure note can be linked to the worst performing of Tesla and Apple, whatever your thesis is. That's the beauty and the elegance of these products. There's no basket option in derivative markets. There are no 3-year options in the listed derivative markets. But more importantly is that structured notes only matter at maturity. How does that work? They're using what's called a European flex option. Never heard of it? It's okay. Most people haven't. Never heard of it? It's okay, because you can't get access to European flex options. Those are only institutional investors. So the problem of doing it your own is that they're American exercise, not to be too wonky. You can get called out of that position. And if you're doing a complicated hedge, where it's a multi-legged strategy, as some of the folks on Robinhood have done and blown themselves up because they didn't know what they were doing, is that they get called out of some of their positions early, and now they're backwards, and they don't know enough about options to do that. And also the benefit of structured notes is they're fully funded product. So if you invest $100 or $1,000 in a structured note, the most you can lose is $1,000. We've heard all the horror stories of some of these other direct-to-consumer companies where these retail traders, unfortunately, have blown themselves up, gotten backwards, don't understand the concept of margin, and they've lost a lot more than what they thought that they were investing. So that's point number 2, is that's the benefit of structured notes. They're fully funded. They can be a lot more safe than doing the derivative strategy. I don't give tax advice, but there's tax benefits to doing structured notes over derivatives as well, because it's the full package. Growth, the structured notes on Apple that I was just telling you about, if it's longer than 1 year, they can be, and please consult your own tax advisor. I don't give tax advice, but from my experience, they can be treated as long-term capital gains versus options taxation with derivatives. And I go back to the Mac. When you go and you start and assemble all of these different derivative packages together, they can actually be a lot more expensive than buying the packaged product. And that's the beauty of our technology, is that on one side of our platform, we automate the manufacturing. Call me Henry Ford for structured notes. I give them the assembly line of all the structured note manufacturing. And then on the other side, I digitally connect them via the Halo Marketplace to financial advisors, financial advisors and institutions across 5 continents. And on that platform, it's about education. It's about analytics. So people know what they're doing, the risks that they're taking, where they go in the portfolio. That's our prerogative. Is I'm not a casino. I'm not here to get you to buy as much as you can possibly buy, which is unfortunately a lot of these retail platforms. They can turn into a casino. Not for us. We're here to protect your investments. We're here to protect your livelihood. And ultimately, it gets back to the savings crisis. We're here to protect your life, if indeed that survey is correct in regards to the number 1 cause of suicide in this country is financial related.
Yeah. And there was, we saw there was actually close by us in Illinois, there was the suicide in the Robinhood trader that we saw, that situation happened, but also the infamous story in the last few years of the guy who took his, life savings, $1 million in Tesla calls, and it kept working, and 1 million became 7 million until it didn't, until Tesla dropped 75%. And all of a sudden, how is Tesla down 70+%?
Yeah.
It's Tesla.
Great cover story in the Journal a couple months ago of the guy who was worth, a few $1 million and then lost it all. And, now he's working in the back office of a sandwich shop.
Yeah.
And hey, he had a great spirit about it. God bless him. But, at the same point in time, investing is not a hobby. You've worked hard for your money. We work damn hard for our money. Protect it. And so, because you're not only protecting it for yourself, what's the legacy that you want to build in the world? What do you want to give back to society? What do you want to give back to your future generations, whether that's your children's or your nieces or your nephews or your uncles or whomever? What do you want to do?
Yeah.
And so that's the importance of what you do. Sure, you want to carve out 5% of your wealth, and I call it, I do it too. I call it the Jim Cramer Mad Money sleeve, and it goes under my alternative investments. I buy individual stocks. For full disclosure, I own Robinhood stock at $8, like eight and a quarter, somewhere around there. It's a trade. But it's only 5% of my portfolio. The other 95% is what I normally do, which 25% of my own family's portfolio is in structured notes, has been for 15 years, well before I started Halo. And that's because you don't want to hit grand slams. Trust me. You do not want to hit grand slams over the long run. Don't swing for the fences. Just hit doubles, man. Just hit singles and doubles, brother. And you'll be well off in regards to retirement.
Yeah, that's reassuring to hear, because the last couple of years, no secret to, I've gotten emails from the audience of just the dismay and dismantle of, it was so, people joke about the GameStop and AMC stuff, but it's actually not that funny when you're like really losing your life. Yeah, there's no fun.
Nothing funny about losing money.
Yeah, there's nothing funny about it. So I assume, the inception for structured notes, you guys launching Halo, it's super cool what you guys are doing, which is democratizing this access to everyone, because
yeah, and you've never heard of it because prior to Halo, it cost $1 to $3 million to buy one product. So if a listener was saying, "Hey, wow, I get 90% of the upside of Apple, and you're protecting me against the first 30% of declines," that sounds awesome. Where do I sign up? I said, sign up with me at Credit Suisse and wire me $1 to $3 million. depending on the institution. So it's out of reach for 99.9% of people. What our technology does, going back to the Henry Ford's assembly line, metaphor, is that we've been able to, democratize this product, to use a word I dislike because it's so overused. Yeah. But now you can buy a structured note on Halo for $1,000.
Wow.
In the not so distant future, we're working hard to get that down to $1. Because our statement and our vision as a part of our quote unquote battle plan or business plan when we started was that we wanted every dollar saver across Africa, Asia, America, and everywhere in between is to have access to more sufficient and efficient savings product. And so that's ultimately what technology can derive. So no matter what your wallet size is, now you have access to just a little bit more comfort. And no one's saying you don't get to enjoy the spoils of the upside, right? A structured note can give you that upside. And when volatility is really high, you can use structured notes to be able to actually get enhanced upside.
Yeah. And is there any risk with structured notes?
Yeah. So look, there's no free lunch to everything, right? As we've learned. The primary risks are threefold. Number one is, of course, there's market risk, right? So just because I protect you against the first 30% of losses of Apple, if Apple goes to zero, right? You've lost 70% of your money. I protect you against the first 30, but you've lost 70% of your money. So there's market risk, of course. Now, given where interest rates are and volatility are, actually now there's principal protected notes. So there's fully principal protected notes. If you are new to structured notes and you work with an advisor and you refer them to Halo, I strongly advise consider a fully principal protected note, which means that if the underlying goes to zero, you still get your money back.
If the underlying stock goes to zero?
Yep. Is fully principal protected. Now, you're not going to get 90% of the upside of Apple. You might get 90% of the upside subject to a max return, saying over 3 years, okay, the most you're going to make on Apple will be, I'm just making up a number, but will be 40%, which is probably where it'd be. That's the most you'll make. That's the cap. So consider that, because it's a great way to wade before you dive. Right. And so just start small, start simple, consider principal protected notes. So the second risk is the counterparty risk. These products are manufactured by big Wall Street banks, a Citigroup, a Bank of America, a Morgan Stanley, as I mentioned before. You're taking their counterparty risk. Things have been hairy, right? Silicon Valley Bank, First Republic. We do not work with them on our platform. They are not issuers on our platform. We only work with the quote unquote too big to fail banks, right? I call them the SIFIs, systemically important financial institutions, the JP Morgans, the Bank of Americas, et cetera, et cetera, et cetera. And so, but at the end of the day, you have to feel confident that the JP Morgans and the Citigroups and the Bank of Americas are still going to be in business. I would argue if they're not, we've got some serious problems, given their balance sheets in many cases are larger than the United States Treasury itself. Yeah. But conversation for a different day. And then the third opportunity cost is the dividend. With structured notes, you do not get a dividend. Okay. So you get 90% of the upside of Apple, but you don't get the dividend that Apple pays. What happens to the dividend? That dividend goes to pay for your protection. So you're trading off the dividend for that protection. I like to say, at least with my own family, if the market's down 30 and I'm down 0, I don't really care about the 1.86% dividend that the S&P 500 gives me.
Yeah, that's smart. And thank you for the masterclass on structured notes.
Oh yeah, I could get super deep and wonky and probably boring. So we're happy to change the subject if you like.
No, this is super exciting. This is my second time now listening to it. One time when we were having cocktails, and now this time with this. But this is even more fun now. But I guess, going into sort of as we transition to the conclusion of the podcast is, first off, thank you for exposing the audience to what structured notes are, because I'm sure for a lot of people up until today, they had no idea that this is possible.
Exactly. I mean, I think if you look at the evolution of finance, right, it's just that. It's an evolution. If you look at the early 1900s all the way through 1970s, not to give you a boring history lesson, we were all stock pickers, right? Like we bought individual stocks. We called Bud Fox, if anyone's ever seen the movie Wall Street before, and we wanted to buy Endicott Steel. And then in the 1970s, Jack Bogle came out and introduced the first mutual fund of Vanguard S&P 500 mutual fund. And at the time, people were like, well, geez, why do I want all 500 stocks of the S&P 500? Isn't that going to hurt my performance? I just want to pick stocks. Well, who's really talking about stock pickers as a big part of their portfolio? A lot of people are now passive, and that mutual fund is quite popular. But that mutual fund went into the evolution of the ETF, and that ETF is now going into the evolution of structured notes. And as I like to say, this is our Vanguard moment. And so this is the next stage of financial investment. I'm not trying to talk my own book because we've got a variety of different products on the Halo platform beyond just structured notes. But in regards to structured notes, it is the Vanguard moment. Why? Is the three trends that I see in wealth management are protective investing, as we just talked about. You should have a halo, hence why we're called Halo, around every investment that you make, right? You need to protect against the downside. Number two is I believe in defined outcome investing. Most of your listeners, I bet you, most of your listeners would say, at the end of the day, I want to make 6 to 8% or 5 to 8% on my money with reasonable certainty. At the end of the day, I think we would all take that in our portfolios. And that's what structured notes can do. They can help define that outcome. Mm-hmm. And then number three is tailored investing, right? I want to be able to customize my own investing. I just don't want to be fit in this box. I just don't want to be what we call in capital markets, Delta One. I'm taking all the upside and I'm taking all the downside. And because we have 3 billion combinations and you can move that little protection slider as much as you want and see how much upside you can get, that's really the future. Everything in our life is customized. Everything is tailored to us, but our investments are not. And this is the future. And so now it's just working our butts off to make sure that we get this, down to the lowest common denominator of even just if someone's got $1, I want you to be able to save it efficiently.
Yeah. Thank you for not only building this company, but focusing on people that aren't just high net worth, because it's, you spent the first half of your career dealing with just the ultra high net worth at Credit Suisse. And now I know we don't like to use the word democratize, but you are democratizing this for everyone. So thanks for building that. And you're 100% right. Our Starbucks orders are customized. Our Spotify playlists are customized.
Everything.
Why are our investments not customized the same way? So I love that you said that. Now there's so many blessings, and it's just from the outside looking in, you mentioned it earlier, which is it looks so cool that you built $1 billion fintech company. It looks so cool that you have 175 plus employees, a beautiful office here, a beautiful company. You're disrupting an industry and you're saving a lot of people, not only their lives and their likelihood about investments, but one thing I love to talk about on the podcast is the negatives. Like what is the challenges of building this, scary moments? Were there any times where you felt like you actually, we might not make it out of this company could fail?
Well, we've always been blessed with capital, and we've always been prudent with our capital. Okay. Prior to raising our Series C round, we had only raised $18 million. And, by the time we raised our Series C, we're expanding across, 4 or 5 continents, and we still, had plenty of cash in the bank when we raised it. I mean, we really only spent $10 million in total.
Wow.
Building our entire company. And so, for those that think that you need to raise a lot of money to build a successful company, you don't, as long as you've got a product that people want and you've got a problem that needs to be solved. Now, from the challenges side, there's plenty of challenges. Raising capital is hard. It's a numbers game. You get rejected a lot, especially when you're doing something new and unique. And those are usually the best, the biggest hits, right? Are the ones that are totally disrupting the way that we live. Not everyone's going to get it. That's okay. Most people won't get it. So, I highly encourage people to have a numbers game when they're going out and raising capital. Don't just soft circle the 5 investors you really want. Talk to 50, talk to 75, talk to 100, and always be in capital raising mode. We're always in capital raising mode. And the reason why we're always in capital raising mode is, one, you never know what's going to happen. So you want to have a backup plan in regards to capital needed, especially in this environment. But for us, at least right now, is that I learn a lot. I get introduced to a lot of interesting people. I get introduced to a lot of interesting partners. And so always be in capital raising mode, plus it keeps you sharp. And so that would be, those are some of the challenges that we've dealt with raising capital. It's just a lot of conversations. It's grit, it's absolute grit. Some of the other challenges too is hiring. Right. In this environment, it's always hard to find the right talent. What's the right balance of talent versus pace of play? That's hard. You will go through turnover. It's okay. Embrace it. That's something that's been particularly hard for me is like when we do deal with turnover, and every company deals with it, especially in this environment, is, it's hard, right? It becomes personal. Halo is my baby. And I believe with every ounce of what we do that we're creating a positive impact in the world. And so, to that point is sometimes, but you need to be able to get out there. You just need to hire. You're not always going to make the right hires. So fail fast in both in regards to your hires, because it's good for them too. You never want to leave people hanging around in a job they won't be successful with, in my very respectful opinion. But number two is, with all the projects that you're doing, fail fast. I mean, we have a number of initiatives inside Halo that we failed on. We just have more that we've won. And that's the fun of it, is like never stop disrupting. And just because you turn more corporate, which we have, we have more layers, we have more management, we've got more processes, and we should. That's our responsibility. But that doesn't mean we don't have fun. That doesn't mean that we don't innovate. Doesn't mean that we don't try to break things and challenge the process. And when we try to break things, we try to break them really freaking fast. Mm-hmm. And so that's when, never believe your own hype at the end of the day. That was something that my boss at Credit Suisse always used to tell me: never believe your own hype. And I say that not only in regards to yourself when you do raise a round and you get all this great media attention, stay humble and hungry. But more importantly too, when you're working on a project, Halo pivoted 2 or 3 times in an early stage. We never lost our value statement about impact before profit. We never lost our mission of protective investing. The way we delivered protective investing changed twice. And we really had to have a heart-to-heart saying, is what we're going to do, does that work?
Yeah.
So, those are some of the challenges. But again, if you haven't failed and you're not trying hard enough, push yourself. Do something hard. Do something that's bigger than yourself. And most importantly, when you're an entrepreneur, believe in yourself, because ain't no one else going to believe in you. Yeah. If it was easy, then someone would have done it.
And guys, that's coming from a $1 billion fintech founder. So I really hope that you can listen closely to that, because you're a testament of that. Now, having 175 people, one thing I've noticed about your energy, even from the first moment that we met, was how cool and composed you are. And it's one thing to launch, like, let's say, and no disrespect to like Yelp and those type of companies that are like, restaurant softwares or whatever. It's a whole nother animal when you're launching in a space where you're dealing with people's money, like people's like life savings is there. I'm so fascinated, and I've sat down with so many different business leaders, how always cool and composed you are. What's the secret sauce there? How do you stay so relaxed?
Servant leadership. I firmly believe, again, it's not about religion. I firmly believe to do something bigger than yourself. I really believe in my mission. I really believe in why we do it. And I believe it's important to stay humble. The world is a very humbling place. And the folks who think that they're better than someone else, who thinks that they're bigger than someone else, that's not me. And that's not Halo. That's not the way I was raised. And I think that's what I love about the Midwest values, right? Is that I was raised under Midwest values, which is I'm a servant leader. I treat people with respect. I treat people with kindness. I find mutual beneficial partnerships. And that's what I advise entrepreneurs to do, is just be a good person. If you do a good person, if you try to be a good person, then the rest takes care of itself. And so, and to that point, right, is perhaps I'm so collected, which I would like to say all of Halo is too, is because we take our responsibility really seriously. And so, even though we're a B2B company, it's someone's money, it's someone's livelihood. It's, it's putting food on someone's table. That's profound. I mean, to give myself chills, that's profound. And so when you have that type of responsibility, you need to own it. It's not a joke. It's not a game. It's not about how much can I maximize and how much can I IPO this for ultimately to see my company tank. Like, that's not what I'm about. And I think that that's the blessing of what Halo is that I've been blessed in my career. I've been blessed with my family. So is Bijou. And so we just have a different incentive. We're here to maximize value for our shareholders, but for ourselves is I'm here to maximize the impact in the world. And so to that point, life is stressful. Running a company is stressful. Markets are stressful. Regulatory requirements are stressful. The moving pendulum of regulations in general on Washington, D.C. is stressful. But, and this is what I tell my own household too, you cannot stress over what you can't control. And so worry about what you can control. That you should stress about. If you can't control it, don't stress about it. Have a contingency plan. Think about things, well into the future of what could go wrong. But don't worry about what you can control. Everything always works out. It always does. And if you believe in what you do, like the Airbnb guys, they're the best story, right? No one believed in them. And they sold Obama O's and there's Obama O's and McCain O's, right?
Yeah.
On the street to raise capital. And I think that's so cool, man. Like that is like people who just really believed, and I don't know them personally and I don't know what their morals and values are, but from a story, from a entrepreneurial story perspective, I think that's so cool.
Yeah.
And that's what it takes.
Yeah.
And if you're not willing to do that, then you should not be an entrepreneur.
Yeah. I love how just raw and authentic you always keep it. It's not all glory and sunshine. And unfortunately, social media now shows you the makeup, right? Like you see how everything is so
Everything's
cool.
filtered.
Even if we're posting something about Halo on LinkedIn, let's say, like it's going to be the cool stuff, but they don't see the grinding that you guys did, the quitting your job, the opportunity cost, it's the decades in the making. It's just like, it's so cool to see.
Yeah. I really appreciate that. That means a lot to me. And now it's about taking Halo to the next level. And the next level for us is, again, not about an IPO. It's about the next level of impact. We have a big focus on the importance of climate change, which has always been very important to me. I have a big focus on social equality, which kind of Halo already is today. But we're launching green structured notes, which has never been done before.
Wow.
But when you buy this type of structured note, it'll go to finance a green project, which is super cool. We're launching Sharia compliant structured notes because the world's largest faith, which is Islam, Islamic faith cannot buy a structured note because it's a bond and a derivative. And so we're launching Sharia compliant structured notes. And that's what it's all about, man, is it's about creating a positive impact, disrupting the world and doing it for good.
Yeah, you're a guest that we have to bring back again, because, and I don't say that often, but because
I feel like everyone's sleeping right now.
no chance, because it's not only like just remarkable what you've built, but what you're going to continue to build. And, I'd love to just, we bring you back to see in 1, 2, 3 years where this is going, because it's amazing that what you've built, you're still hungry. Like everything you say, what I love about Jason, guys, and I'm just saying it unfiltered, is outside of the podcast, when we were at Soho House that night, I mean, just, you were the last one there. As the CEO of a company, that's sort of unheard of, but you took every question, you're presenting, you're all the energy. You don't need to do that. And you're still doing it, and you're spending time with us today.
Leadership.
Yeah, it goes back to that. So in conclusion, Jason, let me ask you this. It's last time I checked, we're at the end of April here, and a lot of not Gen Zs, but 21-year-olds are graduating college next month. I'm
speaking at my high school commencement in about 3 weeks, which I'm very honored for a variety of reasons we don't need to get into. But yeah, I'm really excited in particular about my high school. It's a pretty big honor. George Steinbrenner was a speaker. General Schwarzkopf was a speaker. So I said, man, they must have run out of people to give the commencement speech, but it is my 20-year anniversary.
Wow.
So it's a pretty cool honor.
Well, congratulations on that. And having said that, it comes full circle now, because on every podcast, when we have our mentors every month, I ask them at the end, 60 to 90 seconds, if you were giving a commencement speech, what's your commencement speech? So let's test your practice.
I haven't written mine yet. They're putting me on the spot. The overall theme is that it's a very difficult world. And you brought up the point earlier, which is on social media, everything looks great. And it's a very stressful world for a lot of people that are graduating, because you may not know what you want to do. I was very fortunate as I did. But you know what? I never thought I was going to be an entrepreneur. But what I did know is that I had that end of my life of where I wanted to be, which was to serve my country. And that still is my goal. In a slightly different form. I would like to be the Secretary of the Treasury instead of U.S. Senator for election reasons. I guess it's tough. But the point of the story is, don't worry so much. Don't worry so much. I talked to a lot of these high schoolers. I talked to a lot of students from my alma mater, Northern Illinois University. And there's a lot of tension. There's a lot of fear of, what am I going to do? I don't know what I'm going to do. How much am I going to how much money I'm going to make? And I promise you that you'll find solace if you just find what you're passionate about. Just find what your passion is, and find what your purpose in life is. And that may change over time, but just in the short term, find your passion, find your mission, find your purpose, and go to that. And I promise you'll be able to monetize it. So don't get so concerned about that. And the second piece of advice, we've already talked about it. Do something hard. Push yourself, challenge yourself, fail. It's good to fail. You learn, you get stronger, you get tougher, you become more mature, and do something that's bigger than yourself. Because if we all do something that's bigger than ourselves, I was talking about this the other day. If you influence just 2 people in your life, so I hope I influence just 1 person on this podcast, but if I influence 2, I've done my work. I've done my work on this earth. You know why? Because if every person influences just 2 people in a positive way, we'll have made a change on a global level, have touched every single human in less than 20 years. And that's really profound to think about, because it's the multiplier effect, of course. If every person impacts 2 people, right? It's the multiplier effect. So To create a positive impact in the world, what I ask you to do, just influence and impact 2 people. I'm not asking you to be someone grandiose. 2 people and you can change the world. And that's my ask of you.
That is extremely powerful. That is Jason, the co-founder and CEO of Halo. Jason, I want the listeners to digest that, but where can we find, like, if people are just so fascinated by this, where can we find Halo and where can we see?
Yeah, you can check us out online at haloinvesting.com. We're on all the social media, but come check us out at haloinvesting.com. We have the Halo Journal on there, which is a great section of content in regards to what are structured notes, why to use them, different market trends, investment behaviors, and investment objectives, and ultimately just a lot of great content for you to learn to be a better investor and a better saver.
Yeah, and we'll put all the links in the description. I can't tell you how refreshing it is to bring someone in this industry, which, by the way, as Jason knows, this is an industry that can get very nasty. I mean, you look at the collapse of FTX, you look at back in the 2000s, stuff like Bernie Madoff. So to see someone who's focused on servant leadership, someone who wants to do it ethically and morally and give back, that's refreshing to bring back in the finance community. So thank you, Jason.
I appreciate you. Thank you so much.
Your time. Thank you.
Thank you.